Part 3 stand part, and just for clarification, this is debate on clauses 66 to 220 and on schedules 1 to 3.
Mr. Chair,
Grant Roberts.
I was just pausing briefly there to see if any member of the government would like to stand up and talk about substantive changes to the Income Tax Act that are all about, according to the commentary around this bill, improving research and development, making the taxation system more efficient, dealing with GST and bodies corporates, changing working for families tax credits. Anything? Nothing at all from the government. Absolutely remarkable, Mr. Chair, that, as you yourself have just alluded to, 150 odd clauses, something more than that in this particular part of the bill. The Select Committee spent significant time going through a number of issues within this bill, checking and then rechecking as to how it would be implemented, and not one member of the government wants to get up on their hind legs and tell us why they're doing it. What does that tell us about what they're doing here? What does that tell us about their commitment in particular, Mr. Chair, to research and development, which is one of the major issues dealt with in Part 3?
All for show.
All for show, that's what it is. Because if actually they wanted to do something substantive about research and development, we would actually be hearing from them about research and development tax credits, because that is actually something that the sector wants, that would give some certainty for investment in research and development, but there's nothing about that here. One of the main features, and the one that I want to talk about in this first of my calls, Mr. Chair, of Part 3, is around the cashing out of losses for R&D expenditure. And there's no doubt that there was a considerable level of sympathy inside the committee for this particular clause. Everybody knows, particularly when you're starting out a business, that being able to invest the money into R&D that you need to create the value in your business, to build it, to bring on new products, is difficult at the start. When cash flow's tight, when you've got other things on your mind, you've probably financed the business out of an extra mortgage or something like that, that ability to be able to deal with research and development, or actually get into research and development, is limited. And so we all know that in the first years of life of companies in New Zealand, most of them make losses. It's one of the things that when you don't follow closely the fortunes of particularly small businesses, that a lot of New Zealanders wouldn't understand, that actually the hard graft of the early years of a business includes almost inevitably making losses year on year at the beginning. It is very difficult at that point to be able to put that money into R&D that's required. So the idea of cashing out losses for R&D expenditure is something that we would certainly support. What this bill does, and what this part does, is allow certain loss-making companies, and we'll come back to that in a minute, to cash out tax losses for R&D expenditure to a limit of $500,000 in the first year and $300,000 in subsequent years. Now, the important point here is that while those losses can be cashed out and repaid, once the company makes a return on its R&D investment, they do have to repay it. So that's the point. They can cash it out at the point at which it's a cost to them, it's part and effect of the fact that they've made a loss, but then they've got to return it. And this, to me, Mr. Chair, is the weakness in the National Party's regime that's been put in place here, is that by all means have that as part of the process by which companies can make investment in R&D. But where's the other end of the equation? Where's the ability of all companies to have some certainty that they can invest in research and development? Because it's not here. It is, in fact, a deficit model in all respects. It's a deficit model in the sense that it deals with losses, but it's also a deficit model in terms of the value of research and development. It's just the smallest of possible gestures that could be made to support research and development. Yes, welcome by those companies and those firms who will inevitably take it up and cash out the losses. But where's the imagination? Where's the vision for really kick-starting R&D? One of the lowest levels of private sector R&D expenditure in the world in New Zealand. And this legislation says, well, we'll do this small piece of tinkering that'll help out a few companies deal with their inability to really invest in research and development in the early stages of their business. So I would welcome a member of the government getting up and telling us, is this it? Is this it in terms of research and development, Mr. Chair? Is this it in terms of research and development? Is this as good as it gets in terms of how the government thinks we should be encouraging and facilitating one of the things that will truly drive economic growth in New Zealand, and that is investment in our research and development? So, Mr. Chair, that would be one particular area that I think we do need a little bit more work on. We certainly got submissions in the Select Committee that were concerned about issues like the thresholds. How could the thresholds be increased over the years? How were we making assessments about whether this really was research and development? And one of the things that the committee dwelt on was who would be brought in to make the decisions about this. And it will be, Mr. Chair, I can say that IRD told us in the committee, Select Committee, that would be Callaghan Innovation who would play that role. And the committee members were relatively assured of that. Callaghan Innovation has a broad range of experience when it comes to research and development. There were some concerns raised in the committee as to whether or not Callaghan Innovation had the capacity for this in terms of its own work. We were assured that effectively IRD would be paying for the services. There would be a retainer in effect. The other concern that was raised by committee members was the timeliness of Callaghan Innovation's ability to actually be there, make the decisions and enable a business not to have to sit around and wait to see whether or not the work that they were doing or the expenditure that they were undertaking really was research and development. And again, we were assured by IRD officials that that would be dealt with. But I do think there is a real cause here for a government member to get up and tell us how this in effect does improve research and development in New Zealand and what else they might have planned, because goodness, there better be something other than this. Mr. Chair, there are several other issues in this part which I will come to over the next couple of calls. The next one I want to do is talk about the question of black hole expenditure, which again the committee spent a little bit of time dealing on. The bill amends the rules relating to black hole expenditure, and for those who want a definition of that, which the committee did itself when we were dealing with it, that black hole expenditure is business expenditure that is not immediately deductible for income tax purposes and cannot be deducted over time as depreciation. The proposals are effectively dealing with a number of anomalies under the current rules that were to be fixed. And I guess where the committee got to was around questions like patents, trademarks. How do we deal with those from a tax deduction perspective? There has been some certain, what we got in terms of submissions was that there had been a lot of uncertainty in the accounting profession around exactly what was covered and what wasn't. And the amendment of these rules effectively allows an extension of an asset's costs to include the underlying item of what's called depreciable intangible property. Now that sounds extremely technical, Mr. Chair, but it was from the submitters who came to us a point that they wanted some clarification on. I'll be frank, Mr. Chair, I don't think committee members across the parties, when this was being raised, were able to be completely assured that there wouldn't still be loopholes, because it is such a technical area, and the idea that accountants will now scour through this to see if there are loopholes, whether or not things can and can't be taxed within those areas like patents, and particularly when patents are looked at versus knowledge that already exists. How do you construct a taxation regime around that? We have to have some confidence in the officials here, Mr. Chair, that black hole expenditure is now going to be clear, or the treatment of it is now going to be clearer. But I think it does draw to the attention of the House the importance of definition in making sure that taxation law works, and we have been assured that we've got that here, and I hope that we do. The final area I want to talk about in this call, Mr. Speaker, and I definitely want to hear from a member of the government on this, is the question around GST and bodies corporate. What the amendments here are slated to do is to clarify that services provided by bodies corporate are supplies for consideration for GST purposes and give bodies corporate the option to register for GST. This is effectively about rules that protect the tax base from the adverse consequences of allowing this choice.
I call Dr. David Clark.